Now, despite the drop in the STI today, some analysts say overall market sentiment is optimistic for the year of the rabbit. That's due to the brightening global economic outlook, and they expect the benchmark to continue pushing higher this year despite some downside risks.
While moderating from last year's record growth, Singapore's economy is still expected to turn in a strong performance this year. Service industries, especially the two integrated resorts, are expected to do well. Healthy growth is also anticipated in the high-tech sector. Analysts say Singapore will benefit from continued strong growth in China, which will boost economies across the Asian region.
China is continually expected to grow at about 8 to 10%, and hence that will probably also filter down to the rest of the Asia region. So Asia remains an area of high growth and is expected to continue to grow at much higher rates of growth compared to US as well as Europe. And Singapore, being situated within Asia, will also be a beneficiary of this.
But not all is well with the global economy. Political unrest in the Middle East, sovereign debt worries in Europe, and persistent high unemployment in the US remain significant challenges. There is also concern that the Fed's quantitative easing policies are causing asset bubbles which will burst and leave investors with large losses.
I'm very doubtful that this second round of printing of money would be successful in reviving the US economy. So by the time if they finish printing money by July this year, then if we wait a few months, if the US economy is still not recovering, is still very stagnant and weak, then it might actually trigger a crash in the confidence. And typically when confidence crash, it will be followed by a market crash and most likely a stock market crash.
But analysts say that as long as local companies chalk up healthy earnings growth this year, stocks in Singapore will have room to climb higher.